Okay, let me share the screen. I didn't go. All right. Tonight we're talking about retirement planning. And my advice to every preacher is to do their own. Because, yeah, the church should take care of you after you've spent all your years working for the church, but reality is they probably won't. And if you didn't spend a lot of time in a lot of places, if you moved every 2 or 3 or 5 years, you probably don't know the people very well. They don't know you very well. And yeah, so they probably don't. So retirement planning, we have two options. We have either church plans or ERISA plans. ERISA named for the Employee Retirement Income Security Act, passed in 1974. So it's been there almost 50 years, but this is what governs most of the retirement plans that we have for today in today's environment. Church plans are defined in ERISA as being established and maintained by a church or convention or an association of churches for its employees or for the beneficiaries of its employees. The statutory definition also includes entities which are tax exempt under Section 501, which are controlled by a church or convention or association of churches. So if you've got a church that runs a school and the school is a separate legal entity, the statutory definition of church plans could involve those retirement plans that are sponsored by a church, by a school that is associated with a church or a convention or an association of churches. So 501c3, which is where most charitable organizations exist, that's Section 501 of the Internal Revenue, subsection C, subsection 3, which has churches involved there. And so all those tax exempt organizations which are exempt under 501, which would include C3s and other organizations. Church plans are established under state law and are exempt from ERISA as a provision of ERISA. However, a church plan can elect to subject itself to ERISA under Section 410D. That's ERISA Section 410, subsection D. If it did so, it would be subject to all the ERISA provisions. And let's talk about what some of those provisions are. ERISA provisions include reporting requirements, disclosure requirements, fiduciary responsibilities, non-discrimination rules, payments for coverage under the Pension Benefit Guaranty Corporation, also called PBGC, minimum participation requirements, minimum coverage requirements, and minimum vesting requirements. So ERISA generally, for example, may say that you can't work for a company longer than 3 years without being offered or covered by the retirement plan for that company. You can't work for a company past age 21 without being covered by being offered or covered by the company's retirement plans. If they do something, they can't discriminate against lower paid employees. So in other words, all the benefits can't go substantially to the highest paid employees, and the rank and file get almost nothing. Those are ERISA type requirements. ERISA also fiduciary responsibilities. They list people that are in control of the plan as having a fiduciary responsibility. It means that they have to take into consideration what the beneficiaries of the plan want rather than what they want. What's to the benefit of the beneficiaries instead of the person doing making the decision. So there are a lot of requirements that ERISA includes that churches are exempt if they have a church plan, exempt from those requirements unless they in their church plan make it subject to those requirements. And that was what we saw there as Section 10D election. Okay, we talked about retirement planning and retirement housing allowance. So ministers that are retired, in fact, I just did talked to a minister this week about his tax return, and he is retired and he's declaring still some housing allowance on his tax return. So there are a multitude of cases and private letter rulings that allow a retired minister to have a portion of their retirement income designated as housing allowance. However, initially in Revenue Procedure 89.54 and continuing annually up until this year, and that has been going on now for 34 years, the IRS has stated that this is an area under study, and the IRS will not issue rulings or determination letters until it resolves the issue. So I don't know how long it takes them, but it has taken them 34 years and they still haven't resolved the issue. So I don't know what the issue is. They haven't told us. They don't, but they said in Revenue Procedure 89-54, put out in 1989, they were going to study it, and they would not issue anything, any private letter rulings, any determination letters until they resolve it. So we have a lot of unknown in this area, especially unknown as to what the IRS is studying and when they're going to make a decision and what that decision is going to be. Don't know. In Revenue Ruling 75-22, which has been almost 50 years old, the revenue ruling allowed a denominational pension board as part of the retired minister's pension plan to designate a portion of the monthly pension amount as a housing allowance. And since, as we just talked about, they will no longer issue rulings on the matter, that's the latest guidance that we have on the availability of designating a portion of the retirement payment as a housing allowance. They may make a decision today and announce it tomorrow. They may have made a decision last week and announced it, but so far we haven't heard anything about the decision they want to make or plan to make. However, the Clergy Housing Allowance Clarification Act of 2002 implemented the restriction that the non-taxable portion of the housing allowance cannot exceed the fair rental value of the home, including the furnishings and the utilities. Remember when we talked about housing allowance, we said there's 3 numbers that you have to look at. You have to compare those numbers. You have to take the least, whichever one is the least of those numbers. Well, that came about in 2002 when they passed this Clergy Housing Allowance Clarification Act of 2002. And that's the part that says that those 3 numbers that exist, what you claimed on your housing allowance with the church in writing before they started withholding anything, what the actual costs are of your housing, including furnishings and including utilities, or what the fair rental value of the home plus utilities and furnishings would be. So whichever of those 3 numbers is smallest, you take that as housing allowance. And that came about in this Clarification Act of 2002. Retirement planning. So we're going to talk a little while about ERISA plans. I'm not going to talk about church plans because there's so much variability that can happen in a church plan. But in ERISA plans, ERISA can either be a defined contribution plan or a defined benefit plan. Defined contribution is what it says. We're going to define how much the company or the organization could contribute every year, and that's how much you have when you retire as a benefit. Or a defined benefit would be, as the name implies, we're going to define how much benefit you're going to have, and we're going to calculate how much it takes to give you that benefit, and that's how much benefit you'll have for this retirement account. Now, defined benefit plans are very rare in the US today. Generally, most of the retirement plans you'll see are defined contribution plans. I'll put aside X dollars, or you can put aside X amount of your salary and we'll match Y amount up to so much, and then we won't match anything beyond that. There's a lot of law around 401ks, 403bs about how much you can put aside for, so they are defined contribution laws. So what you don't have are a lot of laws around defined benefits. Generally, defined benefits are from closely held an individual or a small company. Say a doctor runs his own practice as a taxable entity, and he defines the benefit that he and all his employees of the practice should get at retirement. Well, the doctor is generally older than the most of the employees. The doctor makes a whole lot more in salary than the employees do. So he may say, we're going to give you 10% of your salary for every year you worked here as a retirement benefit. And somebody would come in, generally a brokerage house or an insurance agency or somebody like that, and calculate what it would take to pay that benefit. And that's how much you can deduct as a retirement expense. So you could deduct a whole lot more under defined benefit plans, but most of the rules today, most of the retirement accounts today are defined contribution plans. And you see that statement I made there on the last, withdrawals from that account before you're age 59 and a half are subject to a 10% penalty. About the only two exceptions to that are fairly common. I have a client that ran into this year. She turned 55 last year. She had retired from Delta and she was drawing her retirement pay. Now, up until this year, she had to pay a 10% penalty. But once you reach age 55 and are retired from the employer, you can draw their employment retirement plan and it not be subject to their 10% penalty. The other thing that is if you can say that you are taking substantially equal payments over your lifetime, then you may exclude yourself from the age 59 and a half 10% penalty for doing that. But you would have to prove that every year until you turned age 59 and a half, and or be subject to the 10% penalty. Self-employed individuals can also establish a variety of retirement plans. An IRA, an individual retirement account, SEP, S-E-P, a self-employed pension, or a solo 401k. It's like a 401k that you see in the other realm, but generally there's only one or a very few people that participate in it. And once again, if you withdraw from that account before you're age 59 and a half, you're subject to a 10% penalty. So an IRA, an individual retirement account, the maximum contribution you can make every year is $6,000. If you're over age 50, you can add an extra $1,000 to that. and make a $7,000 contribution. Depending on other income, contributions to a regular IRA can be tax deductible. But withdrawals from the IRA are taxable as ordinary income because, and let me back up a minute, generally they're tax deductible, therefore the withdrawals are ordinary income. Now that third statement there, depending on other income, contributions can be tax deductible, implies that depending on the other income, they may not be tax deductible. So if they're not tax deductible, you've got what the IRS calls bases in the account. And you may have to take, if you accumulated some bases in the account, you take that basis over your expected lifetime, and that's how much you can deduct that's not deductible, but all the rest of it would be taxable. Simplified employee pension, a maximum annual contribution of 25% of net earnings from self-employment up to $61,000 annually. Now, when I say 25%, it actually works out to about 20%. So if you wanted to deduct that, you could take 20% of 61,000, you could take $12,200 as an annual self-employee pension, simplified employee pension. And anything that you put in there tax-free is taxable as ordinary income when you take it out. Or solo 401k, a 401k plan for a self-employed individual. This one, you could have a maximum annual contribution of $20,500 plus up to 25% of net earnings from self-employment to total no more than the $61,000. So you see that the SEP and the solo 401k both max out at $61,000. I personally prefer a solo 401k. I know some people that prefer a SEP. It's really, you can deduct about the same amount. On the solo 401k, if it's set up that you can have your contributions from your earnings plus from the company, then you can make the total of $61,000 pretty easily if the company contributes that. But if the company does not contribute anything, you're limited to the $20,500 or $26,500, and the 25% of net earnings. IRAs and solo 401ks can have a Roth version as well. So let's talk about Roth for a minute. Under current law, monies put into a Roth IRA or Roth 401k is taxed when the money is contributed to the retirement plan, and under current law is tax-free when taken out of the retirement account. There are a few rules. Money has to stay in the Roth account for at least 5 years before you can take out the original money. And any earnings have to stay until age 59 and a half or are subject to a 10% penalty. Same penalty we've seen before. Now, the one that's not mentioned here is a SEP. A SEP does not have a Roth version. I know a lot of younger people that as they put money working for corporate America, and as they put money into the 401k, they're choosing to put it into the Roth 401k so that when it comes out 30, 40, 50 years from now, it will be tax-free. Under current law, that's true. Congress has tried over the last 5 years, at least twice, and they keep bringing it back up, of taxing some amount of retirement plans. Haven't been successful yet. What Congress would like to do is all the money that's in retirement accounts be turned over to them, and they, like Social Security, they would guarantee everybody some amount of money. Now, I think most people are smart enough to understand that if they did that, Congress would spend all the money and would not leave any behind and put us on a pay-as-you-go basis, kind of like Social Security is now. When we talked last time about what was in Social Security when it started in 1939, I think, well, it might have been 36. The average person that drew Social Security drew it for 6 months, and then they died. Now the average person draws it for 20 years, 15 years, 30 years, 50 years. I don't know what average is, but I know some people that have been drawing Social Security for 30 or 40 years. Somebody just told me today that the oldest person in America, 2 oldest people in America, lived here in Georgia. And one of them was 116 years old, and one of them was 100 and, I think she said 15 years old. Well, if they started drawing Social Security at the time they were 65, they drew Social Security for 50 years, 51 years, rather than the 6 months that was normal average back in 1936. So that's one reason that Social Security is hurting so bad, is everybody's living longer. Another reason is Congress has spent a lot of the money on doing a lot of other things and not left it there to pay for those people who are retiring. So that's my soapbox I've got on for today. Any questions?
No, sir.
Okay. So my encouragement to you is, if you are a preacher, if you become a preacher, to put money aside If the church is willing to establish a church plan, you put money aside in the church plan. If the church is not willing, you do either an IRA or a solo 401k or a SEP IRA or something like that. Or if the church is willing to let you do a 401 or 403b or something like that, you can do those.
Okay.
So, but I wouldn't rely on the church taking care of you after you retire, because probably not going to happen.
Right.
It's not to the extent you want it to.
That's right. Mhm.
Okay, I'm going to stop now, and we will send out the lesson for tonight under to an email, and I will, let's stop the sharing. Let's stop recording.